right, welcome back to the Tech Corner this week. I'm George Tsilis, Senior Markets Contributor here with the Schwab Network. This week on the Tech Corner, we're going to be spotlighting Alphabet, the parent company to Google, which is one of the Magnificent Seven technology names in the communications services industry space. It operates through three primary segments. Its Google Services, its cloud business, as well as its other bets. Google Services includes widely used products such as Search, YouTube, Gmail, Google Maps, Android, all which generate revenues primarily through advertising and subscription services. Its cloud-based business provides AI-optimized infrastructure services for enterprise customers with significant offerings like the Vertex AI platform and Google Workspace. Now, the other bets segment focuses on innovative products in fields such as health technology and autonomous driving, including Waymo. Now, the corporate mission is to organize the world's information and make it universally accessible and useful with a focus on artificial intelligence integration across its services to enhance user experience and efficiency. The company continues to invest heavily in research and development, emphasizing AI advancements in its operations worldwide. Speaking of worldwide operations, about 52% of Alphabet's revenue is generated outside the United States. Now, when it comes to competition, in the realm of search and advertising, it competes with Microsoft Corporation, which includes offerings like Bing and Azure services. In the cloud services sector, it contends with Amazon.com, which is known for its Amazon Web Services platform. Additionally, in the social media and digital content space, Alphabet competes with Meta Platforms, which operates Facebook and Instagram. Now, Alphabet's unique value proposition lies in its presence as a global leader in search, with the two largest global search engines including Google and YouTube. Some estimates find they control nearly 90% of the market share, making competitive barriers to entry very strong. Now, in recent news, the company will be reporting Q1 earnings on April 24th of this month. The estimated earnings are expected to be $2.04 per share, with over $89 billion in sales. Now, last earnings report on February 4th of this year, the stock reacted poorly, despite the fact that fiscal year Q4 earnings grew about 32% year over year, and sales actually beat the estimates marginally at 12% for the quarter year over year. For the full fiscal year of 2024, the company generated 14% revenue growth on total $350 billion in sales. Some notable highlights in the earnings report included YouTube ad revenue, which climbed 14%, as well as Google Cloud for the quarter grew 30% year over year. Now, in other recent news, on March 18th, the company's Google division announced that it agreed to acquire cloud security platform Wiz for $32 billion in cash. This is the largest acquisition in the company's history. This adds to a rich history of notable acquisitions in the past 2 decades, including YouTube in 2006, as well as Nest and Fitbit. Google expects to integrate Wiz into its Google Cloud business, improving multi-cloud security and the ability of clients to build new software solutions and running them in the cloud. Some of the positive attributes about Google include, if you just look at last quarter's year-over-year growth in cloud services, it grew 30%. They've been gaining market share in competition with Amazon Web Services, as well as Microsoft, which are two of their primary competitors. The company itself excels in profitability. Over the past 12 months, the company generated 29% net income margin growth. This is actually 400 basis points higher than their 5-year average. Now, taking into consideration the price decline as of late, we have to pair that with the earnings estimates on a forward basis. The company is expected to earn close to $9 a share, and the stock is now trading at a forward multiple around 17.74, and that's actually a significant discount to the 25 multiple it usually trades at, a discount of about 28%. Now, if we take into consideration the earnings growth estimates of around 18% for the company, relative to a forward multiple of around 17 times, the company's price to earnings growth ratio is less than 1. Some would suggest this is actually a great value. This suggests the stock is trading at a discount relative to its earnings potential. Now, something to keep in mind in the upcoming earnings announcements is the acquisition of Wiz and how this positions Alphabet in its cybersecurity offerings, potentially diversifying itself away from its competitors like Amazon Web Services and Azure. Now, in light of some of those positives, we also have to address some concerns. First off, Alphabet faces potential financial risk due to its high capital expenditures and artificial intelligence infrastructure. This could weigh heavily on its profitability, especially with the unpredictable nature of global trade policies. While Alphabet is seeking to diversify its business away from search, text-based advertising remains the largest contributor to the sales of the business, creating concentration risk. The company's core business, like Google Search, is under threat from AI-based search, including competitors like ChatGPT. Now, the other thing some analysts were concerned about is the high price Google paid for Wiz, which may pose integration and execution challenges with potential antitrust scrutiny, along with high expectations for rapid recovery of revenue. Now, also in general, when it comes to search, where Google essentially has close to a near monopoly, antitrust regulators around the world are keying on Alphabet's search dominance and could upend the search market through imposition of deep structural changes in the search space. Now, let's take into consideration the technical chart pattern for Google. The stock's momentum is negative, with a one-year price performance of down 1%, and year-to-date it's down 19%. This is underperforming the broad S&P 500 index and indicates investor caution. The stock is also trading below the 50 and 200-day moving averages, while the 50-day moving average recently crossed below the 200-day moving average, which indicates intermediate trend bearish sentiment. However, the stock remains above its 200-week moving average, which suggests the longer-term trend support remains intact. Now, in summary, when we look at Alphabet, we have to consider that it's a conglomerate of stellar businesses. It offers solutions ranging from advertising, cloud computing, and self-driving cars. It has built itself into a true technology behemoth, generating tens of billions of dollars in free cash flow annually. On the cloud side of the business, which is a focal point for Google, it is expected to grow 25% between now and the end of 2026. Now, a focal point for Alphabet is its cloud business. Estimates have 25% plus growth in their cloud business between now and the end of 2026. This suggests they expect to capitalize on AI monetization. As more artificial intelligence comes online to support AI workloads, Google is leveraging Gemini to support higher pricing for its enterprise offerings. This may meaningfully benefit shareholders both from the top line and bottom line profitability perspective. Now, in the next edition of the Tech Corner, we're going to be highlighting Taiwan Semiconductor, the largest global semiconductor manufacturer in the world. This is a certainly close watch name amidst the U.S.-China trade relations tensions. All right, that's it for this week's edition of the Tech Corner. Please like and subscribe to the Schwab Network. I'm George Tsilis. We'll see you next week.